Your company's finance team set the hurdle rate for capital projects using CAPM, the capital asset pricing model. They estimated beta from historical stock prices. They used the 10-year treasury rate as the risk-free rate, all things that we all do. They added a market risk premium from a Dama Duran database. They produced a precise discount rate. And then they used that discount rate designed for public equity valuation to evaluate a capital project in a private manufacturing division that has nothing to do with stock price volatility. The tool was right. The application was wrong. Today, we're going to fix that application. Hello, my name is Todd Hagopian. I'm the original Stagnation Assassin and the author of The Unfair Advantage and The Stagnation Assassin, both on Amazon.com. Today, on the Stagnation Assassin MBA, we're cracking open the capital asset pricing model, CAPM. I'm going to tell you what they teach you in the program, what they leave out, and what you actually need to know if you're running a real business in the real world. CAPM is the foundation of modern finance and a frequent source of bad capital allocation decisions, especially in operating companies. Understanding it well enough to use it and well enough to challenge its misapplication is a core skill for any operator who participates in capital allocation conversations. Now let's look at the textbook version of what this says. And as always, the textbook is usually not wrong in its original context. So CAPM was developed independently by a William Sharp in 1964 and a John Littner in 1965 and a Jan Maassen in 1966, all building on one of my favorite people's theory, Harry Markowitz's portfolio theory. Sharp received the Nobel Prize in economics in 1990. The model states that the expected return on any asset is equal to the risk-free rate plus a risk premium that depends on the asset's systematic risk measured by beta, yada, 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 yada. All real complicated. The formula is expected return equals risk-free rate plus beta times market return minus risk-free rate. Big mouthful. Beta measures how much an asset's return moves relative to the market. Okay, a beta of 1 means the asset is going to move with the market. A beta above 1 means it amplifies the market up and down. And a beta below 1 means it's less volatile and less risky than the market. The key theoretical insight, still valuable, is the distinction between systematic risk, which is market risk that cannot be diversified away, and idiosyncratic risk, which is company-specific risk that a diversified investor can eliminate. Investors should only be compensated for bearing systematic risk. That insight is correct and important in investing. The real world debrief, let's talk about where this holds water. The CAPM earns its tuition in 2 specific applications for you. First, as a framework for understanding the risk-return trade-off, the concept that investors require higher returns for bearing higher systematic risk is correct, and it should inform how operators think about the risk profile of their high capital projects. Higher risk investments, new market entries, technology development, acquisition in unfamiliar industries should require higher expected returns to justify the capital commitment. Second, as a starting point for cost of equity estimation, when building a WACC for valuation purposes, CAPM provides a structured framework for estimating the required return on equity. While each input involves judgment, the framework at least makes those judgments explicit and challenging them explicit. CAPM's greatest contribution isn't the formula. It's forcing you to separate systematic risk from idiosyncratic risk. That distinction changes how you think about portfolio and project risk altogether. The operating room, let's talk about where this breaks down. Here's where the professor sits down and us operators stand up. CAPM fails in the operational application for 3 specific reasons. Failure 1, beta is measured from historical stock price volatility. What? Which is a very poor proxy for the actual risk of a specific capital project. A chemical company investing in a new production facility doesn't have a beta. It has specific project risks around construction cost, overrun, permitting, technical performance and market demand. None of these risks are captured by the company's historical stock price behavior. That's just absurd. Using your company's beta to evaluate a capital project is like using your average body temperature to decide whether to wear a coat. The number is real, but the application is completely wrong. Failure 2. CAPM assumes markets are efficient, diversified, investors are the marginal price setters, and and betas are stable over time. None of these hold reliably in practice. Betas estimated from historical data are notoriously unstable. The beta of a business changes as the mix of a business changes, the capital structure changes, and the market position changes. Failure 3, a single discount rate applied to all projects within a company is conceptually wrong. A company with a WACC of 10% should not use 10% as the hurdle rate for a low-risk capacity expansion in its core business and as a hurdle rate for a high-risk entry into a new market. That's stupid. The projects have different risk profiles and should have different hurdle rates. Most companies don't do this. Some companies, best in class, do and should. The operator's upgrade. So what are we going to do here? 2 corrections to make CAPM derived discount rates actually useful. Correction 1, use project-specific risk adjustments rather than a single corporate WACC. Add a premium for risk to the base WACC for projects that are more uncertain than your core business. It just makes sense. New markets, new technology, new customer segments all get higher risk. Subtract for projects with contractually secured returns. If you know you're going to make so much money, then there's a lot less risk. Corporate WACC is a starting point, not a universal standard. Correction 2, challenge the beta estimate. If your company's beta doesn't reflect the risk profile of the specific project being evaluated, find an industry comparable beta from a set of pure play companies in the relevant business and use that as your beta reference point instead. Again, it just makes sense. Apply logic to these things. The Stagnation Assassin verdict is still adapted. The CAPM is the right theoretical framework for understanding the risk-return trade-off and estimating cost of equity. But applying it as a mechanical discount rate calculator without recognizing its assumptions and limitations produces systematically wrong hurdle rates. So don't use it if you're just going to put it on paper and not put logic to it. Adapt it. Use project-specific risk adjustments and challenge beta estimates that don't reflect the actual risk of the investment being evaluated. That's CAPM, the foundation of finance and the source of misapplied discount rates everywhere. For more on capital allocation and financial intelligence, grab The Unfair Advantage and The Stagnation Assassin on Amazon. Follow The Stagnation Assassin show and learn more at toddhagopian.com. Remember, a single hurdle rate for all projects is a uniform hammer for every nail. Some projects are nails, some are bolts. You have to know the difference to make the right investments.